This episode is brought to you by AARP. 10 years from today, Lisa Schneider will trade in her office job to become the leader of a pack of dogs. As the owner of her own dog rescue, that is. A second act made possible by the reskilling courses Lisa's taking now with AARP to help make sure her income lives as long as she does. And she can finally run with the big dogs. And the small dogs, who just think they're big dogs. That's why the younger you are, the more you need AARP. Learn more at aarp.org/skills.
You're listening to a Mint podcast brought to you by HT Smartcast.
This episode is brought to you by Appreciate, a leading online trading app. Welcome to another episode of Why Not Mint Money. I'm your host Radhika, senior producer at HT Smartcast. Today, we are discussing the role of innovative apps like Appreciate in making global stocks, mutual funds, and ETFs more accessible to everyone. Joining us is Mr. Subho Moulik, founder and CEO of Appreciate. Subho has over 25 years of experience working with major organizations like Andersen, Ernst Young, Citigroup, and McKinsey across various industries, including financial services.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Subho, welcome to Why Not Mint Money.
Hey Radhika, glad to be here.
So Subho, digital finance is opening up new possibilities in emerging markets, making financial services more accessible to wider audience. How is digital finance transforming emerging markets? And what role do apps like Appreciate play in providing access to global stocks, mutual funds, and ETFs?
Yeah, so it's a great question. Let's use an analogy. So if you look at what e-commerce did to retail roughly 10 to 15 years ago, we're on a similar transformative journey with financial services, right? So I don't know how many of your listeners will remember when you couldn't order something on Flipkart, right? Or Snapdeal. Yeah. But back then you had to go to a market. You had to figure out that unless you touched and felt something, you were not going to buy it. And choice was restricted to what was available to you around you, right? There was a physical barrier. E-commerce basically, swept that away and said, hey, as long as you got comfortable with the ability to return, pay easily, get a refund easily, and you were, informed enough by what you saw on the screen, you could now order things, try things, etc., right? And you've seen an explosion of consumer demand, consumer choice, and livelihoods from smaller sellers being able to come online and transact, right, as a result. We're at a similar step change or transformation point with financial services, where typically if you look at financial services, it's actually far more regulated and it's a more difficult journey because it involves money at its core and it involves lots of regulations. But we're slowly seeing that the regulators, the government, and the industry is saying that there is so much inefficiency in the system that consumer convenience is such a priority, and compliance with, security and other aspects are now becoming much easier given the penetration of mobile phones and given the increasing sophistication of our regulators and of the financial system, that you're now seeing a similar digital transformation for finance as well, right? And what that means is I now have much more choice as a consumer. I don't have to depend on who is right next to me in terms of, a bank or an NBFC or some other kind of financial company. I also am getting a lot more information, right? Because services are going digital, services that I did not previously know of, hear of, I can actually find more information on them and I can assess whether I should go and subscribe to them now versus not. And look, this started with UPI, which was payments, right? So the first mover in financial services was payments. And you're now seeing, credit and investments and insurance coming along. And what this basically means is that there is really the ability of consumers to have much more choice, but also to complete transactions at lower cost because cost discovery becomes much easier and much more convenient because everyone's looking to shorten and simplify the journey while being compliant. So I expect there to be a lot more consumer happiness and satisfaction and appreciation for the fact that they have more choice and it's cheaper. But also, new players, new entrants, and more importantly, overall, I think financial outcomes for the common man on the street should improve, right? Because they will be more informed and they can carry out financial transactions at a lower cost in a way that is appropriate for them.
That's fascinating. Now let's spend 2 minutes each to know more about stocks, ETFs, and mutual funds, especially for the listeners who are first time investing in this and they are not too familiar with all the concepts. So it would be great if you can take us through the best way to start their investment journey.
Would love to do that, but let's just start with why people should invest, because that's pretty important, right?
Yeah, of course.
So Radhika, do you have 100 rupees on you or in your wallet or a physical 100 rupee note?
No, cashless.
So let's assume you had 100 rupees, right?
Okay.
Right?
Yeah.
If you kept that 100 rupees with you, right? And let's say we had a time machine and we instantly transported ourselves to next week, right? Same time.
Yeah.
You think that the 100 rupees would be worth the same amount?
No.
Okay, what would change?
I think everything will go up. If you have to talk about time change, with time things go, expensive, inflation. Yeah.
Exactly. So the same tapri chaiwala who used to charge, 10 rupees for the chai might now charge 11 rupees.
Yeah.
Right?
Yeah.
So instead of affording 10 chais, you'll afford, a little less than 10 chais, right? 9 chais.
Yeah.
Right? And so that's really the reason why people should invest, because there is inflation, right? There is a time value of money. And essentially, if you just keep the money you've earned, by the time a year passes by, 2 years passes, not as valuable, right?
Yeah.
So that's why you need to invest. Now, you talked about mutual funds, you talked about stocks, you talked about ETFs, right? So let's just dive into that. So when you talk about investments, right, let's just talk about the range of investments you can potentially make and where mutual funds, ETFs, stocks fit into that. So you could invest in property, right, where you either rent the property or you live in it, so you save on rent. You could invest in gold, which is essentially a form of a commodity, but it's the best known commodity. You can invest in complex assets, right, illiquid, distressed assets, etc. But in all of these, typically what people go to are assets that are liquid. So mutual funds, stocks, and ETFs are liquid. There's typically a price discovery every day. And assets that are easy to access. And they're also very easy to access. So typically, I'd say if you're a beginner investing, this asset class, right, of mutual funds, ETF, stocks is a great one to start with, because there are lots of options even for investors who are still cutting their teeth on investing, right? Now, the difference between mutual funds, ETFs, and stocks are essentially one of the amount of risk you want to take. So for someone who doesn't want to take a lot of risk but wants to invest in something that will grow over time, the best option is an ETF. An ETF stands for an exchange traded fund.
Yeah.
Or exchange tracking fund. So, and typically what ETFs do is they say, hey, I am going to either benchmark myself to an index. In India, that's typically the Nifty 50 or the PS Sensex. Or in the US, it's the S&P 500 or the NASDAQ 100. And it says that, hey, we know that this is a group of stocks that are high quality and there is an index in the market. And typically an ETF basically says that we'll mimic that basket of stocks. So instead of investing in one stock, you're investing in a prescribed basket that no one is actively managing. And you're just saying that I'll basically see what happens to the market. And as the market goes up, my investment goes up. If the market goes down, my investment goes down. And historically, over a long period of time, we've seen markets typically go up. While the market may go down next week and again go down next week and again come up, historically, markets typically go up on an average anywhere from 8 to 20%, right? Depending on which market we're talking about. And so that's the safest option because you're not making a bet on an individual company or a stock. And in fact, you're not even making a bet on what combination of stocks, right? You're taking an industry accepted standard and saying, I'll put my money in there. And what's interesting is typically these investment strategies tend to outperform most actively managed strategies, right? And what's important is the words tend and most, because there are some times when, the ETF approach will not outperform other strategies. And there will be some strategies that are higher performing, right? But typically when you invest, you've got to think about risk reward, right? Reward is how much did my investment grow? Risk is what's the chance of it potentially going bad, right? And we typically talk about, reward in terms of total return and risk in terms of either a Sharpe ratio or volatility of your investment or some other measure of risk, right? And so typically ETFs minimize volatility and maximize return, if you think of that as a ratio. Mutual funds can also do that, but there are so many mutual funds. I don't know if you're a fan of cereal, Radhika, but when you go and look to buy cereal in a supermarket, there are typically like 50 varieties, right?
Yeah, a lot of brands, they're healthy.
A lot of brands. Some are Cocoa Puff, some are heart healthy, some are, right? And typically when I go to a cereal aisle, I don't know what to buy, right? Because everyone seems to be advertising something that's amazing, right? Mutual funds tend to be something like that, right? Especially actively managed mutual funds, because there are so many kinds. Early investors often get confused because if you pick the wrong mutual fund, which is a group of actively managed stocks, your returns could actually be lower than the average index, right? If you pick the right mutual fund, your returns are typically higher. But generally, mutual funds do give you some of the same diversification benefits, and you're picking a basket, right? And so if you have a thesis, or if you have a particular kind of basket you want and the mutual fund gives you that, then you really optimize based on what is the most cost-efficient mutual fund, because mutual funds all have expense ratios, right? So if you put in 100 rupees in the mutual fund, it's not like 100 rupees will get invested. There will be a deduction that the asset management company charges for managing that fund, right? So you typically can prioritize based on who's the cheapest if you have a clear view of what kind of mutual fund you want, right?
Yeah.
If you don't quite know what kind of mutual fund you want, ETFs are even better, right?
Okay.
Now, stocks. If you believe that you have the time to do the research, or if you have a strong view or that particular companies will do well, either because you've analyzed them or because you have an underlying thesis as to why the company will do well, then you can bet on individual stocks as well. But that is the riskiest bet, because an individual company could always go down, right? For example,
why, if I may ask?
Because look at it this way, right? Let's say you believe that fast food companies will do well because there are so many young people who like fast food, and over the next 10 years, everyone's going to eat fast food because fast food is also going to get healthier, right? So I could then say, okay, I want to invest in fast food companies as a group. So you could say, hey, is there mutual fund that focuses on consumer staples or in the fast food restaurant category, and can I invest there? Or you could say, you know what, I'm going to bet, not only do I believe in fast food, but I'm going to bet that Burger King will beat McDonald's, and I only invest in Burger King.
Yeah.
Right? So now you've got to have a lot of information to be confident that not only is your fast food hypothesis, is that going to pan out, but Burger King will also beat McDonald's, right? Most investors don't have a good view of the pros and cons or the strengths of one company in a sector versus the other. And that changes over time. So you have to have a pretty strong conviction. Therefore, it's just more risky, right? Because there are so many extenuating factors, right? Is this company doing well because it's got a wonderful CEO? Is it doing well because it's got IP that will expire in some years? Is it doing well because it's figured out a franchise model, but will that be copied by others in the industry, and then will it lose its edge in 3 to 5 years, right?
Yeah.
etc. So that's why it's a much more riskier bet, right? Okay. And therefore, if you have confidence or if you have expertise, you can make those bets. Otherwise, much better to go the ETF or mutual fund route.
Interesting. And is it important to have a varied portfolio?
It is. So diversification is very important, because if, for example, if you were to say, hey, I only want to invest in EV companies, I'd say no, because then you're just taking a slice of the economy, right? Whereas if you're investing across sectors, you're betting that the economy on whole will do okay. Even if one sector goes up, one sector goes down, on average, you're balancing it out. Similarly, country risk. If you're in India, in today's day and age, there's no reason to expose yourself to only one country, right? So I always tell people, hey, you're based out of India, fantastic. India's a great market, but you don't want to put all your eggs in one basket. And so I would say 20 to 30% of your portfolio should be in another market. And I recommend people to go to the US, which is the deepest stock market and has some of the best companies in the world. And that way you're basically not tied to just India, but you at least have another country, and that reduces your country risk. It also reduces your currency risk, because if you're in India, your portfolio is obviously in Indian rupees. If you're in the US, your portfolio should be in US dollars. And to the extent that one currency appreciates versus the other, that risk is also covered versus always being in one currency. So that's, I think, my take, which is more diversification is typically better. Now, often the difficulty is, how do I diversify? Where do I diversify? And is it costly to diversify? But in today's day and age, there are lots of tools to help you diversify very easily. And the cost of diversification is also not high at all.
Okay. So you mentioned about the US market. Now I'm very curious to know if you can share some practical advice for individuals who are looking to start and manage their investments in international markets, as you mentioned earlier.
So look, I think what's important is the following, right? You have to make sure that you put aside some amount of money that you're investing on a regular basis, because you can't say I'll only invest, once a year, because that doesn't work. You have to have a regular investment strategy in the US. You have to choose, an app or a company that enables you to do that regular investment simply and in a low cost or a cost advantage manner, because you have to transfer money from India to the US. There are fees involved. So you need someone that is offering low fees and low cost of transfers. And then you need some basic, education, some basic understanding of that. And I would recommend folks to start, with either marquee blue chip companies and divide your investment across 5 or 6 companies, or to put your money in an ETF. There are many ETFs available in the US, right? And either of those strategies, I think, are fine depending on how much risk you want to take, right? Therefore, let me repeat, right? Monthly investment strategy of an amount that's material to you, choosing an app that reduces cost of transfers, reduces fees, and is easy to use, and then making sure that you continue to follow a diversified approach even in the US. And so don't just put it all in one company. Choose a basket of companies or an ETF that will help you maximize returns while minimizing risk.
Great insights, Subho. So talking about international markets only, what are some of the benefits and risk, and how can investor navigate these challenges related to global markets?
Yeah, so I think the 3 main benefits are as follows. Benefit 1, you're getting access to a group of investment options that are typically world beaters, right? So if you look at the technology sector, if you look at the energy sector, if you look at the defense sector, the companies that are world leaders are actually US listed companies, right? And so as an investor, you want to invest in companies that are winning, and there's a very large number of winning companies you have access to, right? So that's 1. 2, historically, because of the way trade happens and because of the way the differential in interest rates and inflation is, the US dollar has typically appreciated on an average anywhere between 3 to 5%, right? It varies on an annual basis versus the Indian rupee. So that's almost like a built-in booster to your return when you invest in the US in international investments, right? And just to give you a sense, right? I mean, 3 to 5% is nothing to sneeze at. It's a material amount. And as you compound it, it becomes more and more significant, right? And then finally, I think as you look to invest abroad and you read up and your skill level grows, there are more complex investment strategies you can execute that are much more difficult to, in a local market, right? Because there are, as your investment portfolio grows, you can actually move into doing other interesting strategies outside just stocks and mutual funds. But obviously, I wouldn't recommend anyone to do that till they got a couple of years of investing under their belt in stocks and mutual funds, right? So those are the benefits. The risks are that, you get too carried away by a current meme and you put all your money into one US stock and then something happens and it crashes, right? Or the risks are that you say, hey, I want to put my money into some unknown crypto asset which no one has heard of because that's also international investing. So I think the risks really are to do with the choices you make when you invest internationally, and are you making stupid choices that are not diversifying risk, that are not well researched, and that might end up in you losing your capital, right? That's the danger, but there are easy ways to prevent that from happening.
Which meme, by the way, did you just refer? The previous answer. I'm curious to know.
Well, I mean, there were many memes, right? So if you go back to the GameStop memes, if you went back to AMC, there was a recent Nvidia meme, right?
Yeah.
I would not invest purely on memes, right? Is all I'm saying, right? Sometimes memes are nothing but a reflection of market sentiment, and sentiment-based volatility or momentum investing is an interesting strategy. But investing based on a meme is not an interesting strategy. It's a dumb one.
Yeah. Does your app offer this facility? For example, if I am curious to invest and I want to take this opportunity and invest in US market, can I use your app?
So I'll give you an example, right? So I'll use your name, but it's actually a real story of one of our investors, right? So if you had come to me, let's say 3 months ago and said, hey, let's make a number up. I won't disclose the actual investor's capital amount, but let's say you had 50,000 rupees, right? That you had saved up, that you wanted to put into US stocks, right? So I had someone who came to me and said, look, I think it's very interesting, but I think it's very complicated and I don't know how to do it, right? And so I said, great, look, it's not that hard. Please download the app. So downloading the app took about, 10 seconds. We opened up the app. Registration took another, 15 seconds. We then went through a, regulatory compliant KYC process that took about 2.5 minutes. Okay. And why did it take 2.5 minutes? Because she did not have her PAN card and Aadhaar on her. She had to go to like a cupboard and fetch it. Then there was a VKYC process for VKYC, right? There were a couple of questions. So including all of that, right? It took about 2.5 minutes, and it was virtual. It was done while sitting in her drawing room, right? And I had to obviously leave the room during VKYC because that has to be done with no one else sort of prompting you in the room with you. So we came back and then we said, okay, fine. How do I transfer the money in? The money was transferred through UPI. Super easy. The transfer to, our Appreciate wallet in the US took about 3 clicks. And, we soon went into the conversation of what should I buy? And this person, for example, ended up buying an ETF that mirrored the S&P 500, and half the money was put in there and half the money was put into Nvidia, right? Because we were talking about AI and how exciting it is. And she had done her research, and initially she wanted to put all her money into Nvidia. And I said, look, you'll probably get amazing returns, but from a risk perspective, just moderate your portfolio. So I think the Nvidia investment then gave her a good 30 to 40% returns. And the S&P investment is on track to give her, 12 to 15%. And it was literally a 5-minute process. There were no fixed fees on the transfer. Brokerage fees were minimal. And she now has, if she put in 50,000, it's now closer to 80,000, right? In this particular case. Now, every investor's experience will be different. Depending on what they invest in, their return profile will be different. And so you can't take one example and say, great, I'm going to have the same outcome, but the experience, the ease with which the investment was made, the low cost nature of how you transact will all be true for you, Radhika, right? If you wanted to invest, right?
Yeah.
To give you some context, we set up Appreciate because we believed that people in India should diversify their holdings, right? Which meant that obviously they should have exposure to international markets. But even within India, how do we actually enable people to build diversified portfolios and get the maximum return for the lowest possible risk? So that's how we set up, the wealth-focused portion of Appreciate. And we're, excited to help more and more people begin and continue on their investing journey.
That was really fascinating to know. Now I'm curious to know, how do you use AI to improve the user experience?
So we use AI in 3 ways. We have a product where we recommend high-performing portfolios, right? And the portfolio is built using an underlying AI ML model that builds a customized portfolio based on your starting portfolio that you already have, and then builds additional investments you can make so that your resulting portfolio has the highest possible return for the lowest possible Sharpe ratio. Sharpe ratio is nothing but a measure of volatility and risk of the portfolio, right? And so that portfolio has been performing quite well. We just published a paper on that. We've been delivering returns that are higher than most comparable portfolios at a Sharpe ratio that's about twice as much, right? So we use AI ML to offer portfolios that should give better outcomes. But again, I have to caveat that there is no guarantee and all investments subject to market risk. But we use AI to give people recommendations that they can use and assess to see whether they should invest in something that an AI model is suggesting to them or not, right? So that's one. The other thing is we often have people who come onto the app who are looking at something. So we do have, we sort of track what users are looking at so that we can surface to them news related to what they're tracking, news or analysis related to what the interest areas are. And we're about to introduce a conversational AI element on the app in due course. And so that's another way, which is how do you provide the right information, the right insight, and soon the right conversational nudges so that people have discipline in their investing and are better informed, right? That's the second way. And the third way is really, and this is still early days, but we're, on track to hopefully bring something to market next year, is to say, how do we bring in more advanced technical analysis and simplify it so that, you and me can actually use it? Because today you have a number of very highly technical trading firms that make a lot of money, but most of that technical analysis is beyond the normal everyday investor. And so we're working on how AI can actually break that down and present, small actions that our investors can take on their portfolios that are backed by complex technical analysis, right? Not just portfolio construction. That is actually, an aid to small investors and gives them more information to make potentially, the right decision or the better decision. So that's how we are using AI ML.
Great. So now, Subho, as we conclude this episode, could you recommend 5 top mutual funds or stocks, especially in US market?
So I will, because, there are risks with stocks, I'll give you stocks you should potentially look at.
Okay.
Right? And please remember, you have to do your own research, but these are, let's put it this way, these are stocks, I hold and people I know hold, right? And they've done pretty well. So early on, at the beginning of, before AI was a meme, when I was looking at this, I saw that Microsoft was quietly making a number of very interesting bets, including its investment into OpenAI. But also, if you think about it, right, they're also increasingly making investments in platforms related to the job marketplace, the acquisition of LinkedIn, and related to office productivity in general, right? And I think they'll be pretty well placed with both the transition to the cloud and the transition to AI, given their investment. So Microsoft is a favorite of mine. So that's one. That I would encourage people to consider. If you think about what's happening in the EV space, the Tesla stock's taken a hammering. But if you look at the fundamentals, right, there's a piece founder Yogesh on why long-term, right, Tesla should actually ride that out. And by the way, I think there's going to be, Tesla's entry into India as well, right? That's unknown and not quite firm, but that itself could be a pretty interesting upside to the Tesla story. So I think Tesla is down, but there are, I think, interesting tailwinds about to appear. So that's the second stock. The third stock, I'd say, is, as you look at everything that's happening, insurance in general. So it's not a stock, it's more the sector. I think large insurers are going to have more claims that are being paid out, but are also going to raise premiums. And net, I think insurers are going to do much better, right? Especially because more people are going to take insurance, while they're going to be larger gray swan events, right? Not quite black swans, but gray swan events. I think increase in insurance premiums are going to more than make up for it. So in the US, for example, I think insurance is a pretty good sectoral bet to take, right?
Interesting.
Right. Fourth, so I'm giving you a mix of stocks and sector and indexes. If you can't really go wrong investing into the S&P 500, and here's why. Does it have all sections of the US industrial sector? It is also heavily weighted on tech. So you actually get a pretty nice tech weighting, but you also counterbalancing with other industries. And so the S&P 500, for someone who has less risk appetite, doesn't want to go into a single stock or a sector, the S&P 500, I think, is a great bet, right? And then finally, I think you're going to see some pretty interesting developments in pharmaceuticals and bioengineering. So from a sectoral bet, I don't think the last global pandemic was the last one. I think there are likely to be others. There are likely to be other climate-induced issues. So either you can invest in the pharmaceutical sector more broadly, or there are some pretty interesting companies, the makers of the latest generation of weight loss devices. There's an upcoming Alzheimer's diagnostic and medical solution. And there's going to be something for, at some point, be another interesting bet, or you can take bets on 2 or 3 of the winners from the last pandemic. They're likely to continue to be winners. So those would be my 5 recommendations, which is a mix of individual stocks, indexes, and sectors.
So EV, pharmaceutical, medical, and all of the spaces, I guess you've covered very nicely. And I do want to have more discussion, but we do have some time limitations. So Subho, thank you so much for sharing your insights and for being on the show. It was very informative. I would love to host you for the next episode.
Lovely, Radhika. Lovely talking. And by the way, when you do want to invest, you have my details. So
sure,
let's hook you up and let's get you invested.
Sure, I'll do that. Thank you so much.
Thank you. Bye-bye.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.
We could try to explain what it feels like to get your work done on a John Deere. The way a Z-Track mower finishes in half the time you thought it would. Or how much easier it is to move mountains of soil with the 1 Series tractor. We could even go into detail about how it feels to tow up to 4,000 pounds behind a Gator XUV. But if you really want to know what it's like to run with us, you just have to get in the seat. Learn more at johndeere.com/get-in-the-seat or visit a dealer near you.